LBR LBO Infrastructure Summit 2016.
Good afternoon, everyone. It's happy to be with all of you. Standard Chartered Bank has had a significant presence in Sri Lanka since the 1880s. There's nobody more than myself and my colleagues at the bank who'd love to play a major role in the $40 billion of infrastructure development that we're discussing here, we've been discussing all day. But I think it's also important that we examine the situation at present and ask ourselves, what do we need to do to make that a reality? And I think, does Sri Lanka really present a favorable risk appetite for the investor and the financial world to embrace at this moment? Does the country have the financial and social order to maximize all the opportunities that are presented? Financial institutions of all kinds have many considerations to take into account, and one of them is something called country risk. Every country in the world, every lender or financial institution involved in advising, structuring, distributing, or lending takes a view on each country that it's doing business in and creates essentially a limit in their mind or a threshold, and it's broadly just known as country risk. And I'd like to address for a moment this concept because it's critically important for Sri Lanka as well. So what are some of the factors that impact or shape the notion of country risk? Well, one would be its risk rating, and as it's been discussed already, lenders and investors have an appetite and confidence to raise certain large amounts of money and required funding, and a country has to achieve a steady and consistent risk rating so that it can receive the kind of financing, the long tenors it needs, and the favorable pricing to make their projects viable. So ask yourself, is it realistic to surmise that a country with an S&P rating right now of B+, with a negative outlook, can raise this kind of money? Or should the country be required to perform perhaps at least a BB level or better first over a sustained period of time before investors and lenders can be persuaded to commit such large amounts of development funds that are being discussed today? So improving country ratings is very important to this formula. Another area to consider are fiscal policies and procedures. A country's fiscal discipline, its current account deficits, the revenue collection mechanisms it has, and the other basic building blocks of financial well-being are critical factors to consider when organizations wish to develop an appetite for taking the types of risks necessary to provide the price and the terms for money to build desired infrastructure. Consistency of policy is very important. So we can't have any voter-friendly gimmicks or we need a coherent long-term policy, properly passed, properly executed, so investors can rely on sound business objectives and strategies without fear of retrospective impact or capricious change. The tax structures and their impacts are important. And maybe at this time, this is very opportune for the country to revise significantly its tax system, that's taxpayer out there, which is actually underway in the hands of the IMF as we speak. Trading systems, as you've heard already, need to be upgraded so they achieve strong secondary markets that can be created for debt issuances, both government and private. And we have to bring the financial derivatives into this market so they can enhance the capital markets. Today, a currency swap, I think, is frankly no longer than a year. And if it is, it's with very limited appetite. So we have to look into other ways of raising money as well, and perhaps new alternative funding mechanisms like Sukuks, Panda, Samurai bonds, just to name a few. We also need legal frameworks and industrial regulations that are viable. No other country or lender will provide these amounts of money to a nation unwilling to help itself through proper structuring of the labor force, clear and consistent legal infrastructure that creates that required appetite and support for these projects. So A legal system is in place, of course, but court cases, as you've already heard, can drag on for years, costing time and money that could be better spent someplace else. We have to revamp the procedural aspects so that we ensure efficient resolution and provide the required degree of comfort to the potential investors in the event of the dispute. The labor law needs to be much less skewed in favor of an employee and facilitate a performance-based employment environment instead. Some of the current challenges facing us right now are, well, the first quarter GDP growth was pretty good at 5.2%. Second quarter was 2.6%. So we've got about a 3.9% growth rate this year. Still not bad, but not great. The growth in short term is challenging right now because we've got a tight monetary policy out of the central bank and we have fiscal consolidation underway. We've got a high debt to GDP of, I think, 74% or something like that this year. And we lack investor confidence. The average FDI for the last 4 years has barely been $1 billion. We aspire to 4 times that much if we want to take the $40 billion over 10 years. Now, the government is aligned with the IMF guidelines that have been laid down recently, and that's to reduce their fiscal deficits from 7.4% of GDP last year to 5.4% this year and 4.7% next. However, achieving this is going to affect short-term growth. The increase of that from 11 to 15% means that this reduction can be facilitated, but the Cabinet's only just approved it. A change has to go to Parliament, so we hope that something like this might be ready in November. But that VAT increase was expected to take place earlier this year, and it was expected to add 0.6% of revenue growth to GDP. So achieving this year's deficit number of 5.4 is, well, challenging. We've already heard also that the public sector debt is very high, over $9 billion, and almost 94% of that's in the state-owned enterprises. This has got to change if we're going to free up this economy for broader sources of investment. Tax collection, of course, is a problem and a challenge. The ratio of tax revenue to GDP has fallen from, I think, 13% 10 years ago, down to 10%, now maybe up to 12%, but that was largely based on one-off super gains taxes, so that doesn't really count. The low level of domestic revenue generation is what's hampering much of the fiscal and macroeconomic management, and it magnifies the reliance on both domestic and external debt. So the fundamental reforms to the tax policy and its administration needs to aim to raise more than 16% of GDP of sources of revenue for this country. Now, there are opportunities. This ECTA taking place right now with India is one of them. We're looking, I think, to Hong Kong and China for more free trade agreements. Making headway in these free trade agreements will create windows of opportunity, and this can be encouraging. Let's consider, we've talked a lot about the Colombo International Financial Center, renamed, I guess, from the old Port City, and as a major sort of step forward. Let's consider the makeup of another international financial center, in this case, Mauritius. So ask yourself, are these conditions that exist in Mauritius today in place in Sri Lanka? Mauritius has been free of exchange controls for the last 20 years. Its ease of doing business index, I think, is number 19 in the world. It takes 14 days to get a work permit, 2 days to register a business. It has tax treaties with more than 30 countries. Its Board of Investment has a sector that champions nothing but the work with the private sector. Mauritius organizes 6 roadshows a year in collaboration with the private sector. 30% of India's FDI flows through Mauritius. That creates an enormous dollar liquidity. Why couldn't that come through us instead? Its legal system is both English and coupled with French law, and I think the ultimate authority is Privy Council in the UK. It has a fully fledged arbitration center, and large French BPOs have set up there. we've also mentioned earlier that the development of the equity market is important. So, as we gather today to talk about what we desire for this country, which none of us, I think, wouldn't say that positively, we need to understand where we are today, and that partnership with the government in achieving the macro and fundamental stability of this country goes part and parcel with our ability to incentivize the lending community, structuring community, advising community of the world to come and participate in our much-needed infrastructure. So I just thought it's important that we understand where we are, we understand what our challenges are, so that we couple that with the realities of the present moment, and we seek to achieve our goals and objectives in tandem, jointly with the leaders of this nation. Thank you very much.
LBR LBO Infrastructure Summit 2016.